investing what is comfortable is rarely profitable. With that as the theme, welcome to our Zoom web series hosted by One Tree Hill and PMSs on the Juggernauts. Conversation with uncommon and curious fun manner. We have with us today Vaibhav Sanghavi, who is the co-CEO at Avendus Absolute. Welcome, Vaibhav, to the Juggernauts.
Thank you very much. I mean, it's a pleasure to come on platform and exchange kind of views.
Excellent. Vaibhav, what we like to start off with is what we call a machine gun 15. Quick fire round of questions. Hopefully, you will have as much fun as we do. So, if you're ready, I'm happy to shoot away.
No, of course, I'm ready. I mean, not that I'm a little slow in terms of responding back to a question, but I'll try my best.
Okay, perfect. That's all we want to hear. Super. Is gold the panacea to all our diversification questions?
I think at this point in time, it looks like, but if you ask me, in a global market scenario, you will never find that one thing is always secular, right? Things keep on changing, keep on moving, purely because the underlying variables keep on changing. So something to make a far-reaching kind of statement is kind of tough. And what I would imagine is basically at this point in time, the last 2 years has been favorable. Maybe in a year's time coming, may continue to do well, but over a longer period of time, you have to be very dynamic in terms of your own asset allocation, rather than sticking on to something which should always be there as a part of the portfolio.
So probably a buy and hold needs to be more of a dynamic buy and hold now?
Of course, and that is where I'm coming from. It is purely because it's not that we would not want to hold for a pretty long period of time. The point being here is basically that the global markets, irrespective of asset classes, the number of variables always keep on changing. You are into new form of markets, you are into new form of variables. So you have to learn many things at every given point in time and how it kind of impacts to the other assets. So that's always a constant learning process, and you have to be pretty flexible and open in your approach to actually understand which kind of will move at what point in time.
Sure. And sort of, staying on, the different things that people are looking for in the market. What do you think is the motivation for today's investor? Is it consistent returns irrespective of what interest rates are doing? Is it alpha or benchmark? Or is it just saying that, look, whatever the FD is giving, I want 3% more than that?
That's a golden question, right? Because, it all comes or boils down to investors' psychology, or we call it to an extent behavioral finance. But a common investor or any investor, right, would want to have maximum return with minimum risk, right? That's the golden rule. So, which is not possible always, right? However, to kind of achieve the goal of pretty decent return, or I would rather say risk-adjusted return, it is extremely important to kind of diversify your investments. And what we are looking is basically having some exposure, to each of those kind of asset classes, which one would be kind of little aggressive asset classes, or within an asset classes as well, or can be an aggressive strategy to a conservative strategy, or consistent strategy. So we interact depending upon how the macro environment is. The preferences keep on changing. So something like a couple of months back or 3 months back, when this whole COVID kind of impact came about, people's preference was towards capital protection, correct? As people start seeing markets kind of stabilizing and now kind of move up, the goal again kind of shifts back to saying that how could I make more return?
Sure.
So it is extremely important for somebody to have a consistent approach towards your portfolio, assess your own risk return parameters, see what you're comfortable with, and then kind of approach your investments accordingly, right? It is easier said than done, but it is extremely important, right? So that you don't get emotionally impacted, either negative or positive by the market conditions.
So be greedy and cautious at the same time, if that's possible.
Of course, which comes to the greed and fear aspect. Again, greed and fear, to be very on an objective basis, are emotions, right?
Yeah.
And where I would come from is be objective rather than being greedy or fearful.
Okay, fair enough. The next is something which is sort of on everybody's mind, I'm sure, including yours. Uh, the markets seem to be on a tear, right? Sure, there might be a few blips here and there, but definitely not reflecting what seems to be on the ground. We've also talked about liquidity as being a primary factor, but are there any more relatively big factors that are driving the markets up?
And you hit the nail right there at the right time, in the sense that liquidity is one dominant factor which is kind of affecting the current market condition. Let me kind of spend 1 or 2 minutes here and try to explain why is it that it is kind of happening. Now, if you go back in 2008 and 9 when Lehman actually happened, people would have assumed that it's the end of the world, the monetary system is gone, the financial system again is very vulnerable, and so on and so forth. And then came Fed. And at that point in time, the balance sheet size was about $750 billion, right? And within the next 6 years or 7 years, because they quantitative easing programs, they went to about $3.5 trillion over a longer period of time. Now, cut that and come back to 2020. We've seen that in 2020, in March, actually in February, the Fed balance sheet was about $3.5 trillion, roundabout. Within 4 months, actually, it has expanded to $7.5 trillion.
Sure.
Okay, so the quantum of increase in Fed's balance sheet in a very short period of time, and this is only about Fed which I am talking about. If you combine other economies in terms of their both central governments or central bankers and the government push, which is both monetary and fiscal push, it is close to $20 trillion.
Sure.
Now, imagine this kind of number. When these kind of numbers or this kind of liquidity is thrown into the global markets, it has to move into assets, right? Of course, there will be some inflation purely because this time around the fiscal side also is pretty high. So you will see some amount of inflation coming back. But we have to understand that you cannot ignore the quantum of money which is being supplied in the global markets. And that is why it will find their way into assets. Last time we've seen valuations started to inch up. This time again, we'll see those valuations started to inch up. So there's a huge amount of similarities in that context.
Okay, fair. So, but then the question that I have, Vaibhav, is we've seen a good amount sort of polarization versus normalization, right? Where it seems to be right now, a lot of the indices or the headline indices are being run up by 10, 15, 20 stocks. You could argue, look, they'll do better, they'll get more market share, etc. But these represent, from a quantum perspective, maybe 10, 20% of all the stocks out there from just the number. What happens to the remaining 70, 80% of the stocks?
Yeah, good question again. Because see, I'll attribute 2 or 3 reasons to it. One, which you rightly mentioned, is basically the fundamental attributes of those kind of companies who are powerful, have capital, have risk management system and management bandwidth to kind of use this situation to grab market share and opportunity. Okay, because they have all the power with them, whereas the others are probably struggling. So that's one. Two, from a technical perspective, right? All these big names are huge weightage in terms of their respective indices.
Sure.
Okay. So by default, whenever the money comes in, these are the biggest beneficiaries in terms of receiving those kind of flows. Third, last but not the least here, while I did mention about this huge amount of stimulus and excess of money which is lying there, we have to understand again from an investor psychology perspective again here is that liquidity driven rallies in their own experience have been always kind of shallow or of disbelief, and there's always lack of conviction into that. And when that happens and you have money to be deployed, you would rather go and deploy it into the frontliner names rather than into your broader market. Purely because the reason being is, should something go wrong, you want to get out pretty quickly and kind of take your money back, right? And that is why these kind of names who are relatively safe keep on attracting more and more money, thereby elevating their fundamental ratios as well.
So just looking at that, and the big numbers that you took, Vaibhav, by that very definition, and if everyone knows about what you're talking about, liquidity is there. There has to be some kind of a opportunity in other stocks as well, right?
Of course. So what happens is basically when liquidity flows, the first kind of target would be your large cap names, always. When you see those valuations extremely full and very difficult to kind of put further money in, is when you will try and find the second line stocks, the third line stocks, and you will see that trickle happening into the broader market, right? Till a point when suddenly there is a risk of the global markets, and you see everything tanking, and the most impacted would be your mid cap and the small caps later on.
Sure.
Right? So it's again the whole same cycle which kind of plays every time. But investors being investors, they always keep on trying to find those kind of opportunities, right?
Perfect. And sort of, talking on investors, you've been around for decades now. What is that one mistake or one misconception that investors have that keeps repeating over and over again?
One thing which we strongly believe is that we need to be flexible in our investment approach. Okay. What we find in various investment gurus, various market participants, are that they are absolutely attached to their own philosophy of investing.
Sure.
It may have worked for them for some period of time, and it will not work, in certain pockets of time, right? While it's suited for them, the broader investor base actually learns from them and tries to be like them in terms of emulate them, right? Not realizing that the risk appetite of what that person has is completely different than what you have.
Sure.
So rather than focusing or putting their mind to risk, of investments, they always focus on returns, right?
Sure.
Which again brings me to the point that people always try to maximize the return rather than optimize the return. And there's a difference between both of them. When I say maximize, is basically they try, it's like a high risk, high return game, right?
Sure.
Right? Optimize is basically for every unit of risk you are taking, you are optimizing your return. Right? So that's the difference. And I've time and again found that people just miss the whole aspect of actually taking risk into their calculation of your investments portfolio.
Sure. No, that's a super answer. And, obviously, I think what these events teach us and multiple times over is to always look at your portfolio at a holistic level and make sure that, you're not skewed towards one asset, and making sure your risk adjusted returns are optimized rather than maximized. No, absolutely. Moving on to something interesting, what is that one aspect that very few people know about you ever?
About me, I mean, I think it is pretty much there. I mean, I am
No, there has
also.
to be something. There has to be something interesting. What is the most interesting thing about you?
I also get. So let me put this way, right? I also get scared of markets.
Okay.
Because that scare is necessary, right? For you to be on their toes. In terms of kind of knowledge perspective, and I do genuinely think that the level of my knowledge is far lesser than many of the learned people out there into the markets. Maybe I just kind of catch up by probably using some analytical tools or using my common sense. Of course, there is there everywhere, but I'm just saying I try to use it more often. And as I said, being scared of the markets always helps me to be pretty much there. So
okay,
yeah.
Okay, excellent. You never got that answer before, so full marks to you on that. Are you an optimist, pessimist, or a realist?
I am a realist with an bias for optimism.
Okay. Excellent. Great, Weber. We've come to the end of the Machine Gun 15. Happy to say you've come up with flying colors. And if you're a Bollywood fan, your coffee with Karan hamper should reach you at your office sometime soon. Hopefully, by the time we are unlock, maybe 11 or 12, I think.
Yeah.
But, so talking of the unlock and locking down, where are we headed? Is it something where the lockdown was very synchronous, right? And clearly the unlock seems to be anything but that, where you have states saying different things, you have saying the center saying different things, and maybe in your house people are saying different things, right? How is that going to pan out for the future?
See, one thing we need to understand here pretty clearly is that, of course, this virus has caused that kind of dislocation everywhere in terms of the economy, in terms of corporate earnings capacity, and so on and so forth, and markets. But what we need to understand here is basically that yes, this is on a health perspective is something one needs to be pretty vigilant about. But it is not as bad as what people earlier used to think about. Now, if you look at these kind of numbers in terms of what the total number of infections are, I would surely imagine that the unaccounted infections would be way, way higher than what they are. So, for example, the antibody test which you had done actually reflected that what is the amount of population which has got those kind of antibodies already, correct?
Sure.
Which makes me, a little comfortable saying that if you then calculate your death rate or fatality rate, it is far, far less. It is the fear, of course, everywhere that you don't need to get. I mean, you need to be extra careful and so on and so forth. But looking at the data, I'm not too as concerned as I was probably earlier, and that is what it is reflected in terms of the opening of the economy as well. So my sense is basically it will continue to open at a gradual pace, and probably it will think probably normalize probably in say about 6 to 8 months, and after which we would be back to same situation again. And this is just a pure temporary phase, is what I would imagine.
Sure, fair. And sort of, now, Vaibhav, if you could, uh, what our audience actually loves to know is, and from successful people like you, is that, at Avendus, you've tried to build multiple businesses, right? Obviously, started with the Absolute Return Fund, in which you guys did really well. Uh, but what has been that sort of edge and that USP that has made you successful, Vaibhav?
So I think the edge and the USP again, as I said, is you should do what many people wouldn't even think or imagine of doing it. Whenever, in fact, right from standard seventh or eighth, right? When I was in school, actually I started probably applying for IPOs. Okay,
Okay.
and
Excellent.
it is that passion which has probably brought me to the market. And in my tracking of the markets, as always, you learn a lot of things. And the one most important thing which we learn, which people don't do, is risk management, which I just alluded a while back.
Sure.
Our whole focus on any of the strategy which we launch or we try to manage, the focus is on kind of tackling different risk aspects into the portfolio of how do we manage it very effectively. Okay. In terms of my absolute return and my enhanced return product, it is solely concentrated on managing market risk.
Sure.
There is something called ESG product, which is solely focused on addressing the tail risks of a business. And any future products which may launch, again, the whole focus would be how we mitigate different nuances and aspects of risk. Thereby, we want to launch something which is a value addition to the portfolio of an investor and gives a better risk adjusted return at the end of it. If you are able to do that consistently, we have seen that investors probably stick to you over a very long period of time.
Okay, fair enough. And all these structures that you've talked about, and you've obviously been in the thick of things. Are we going to see a pass through for CAT 3 this year?
Yeah, we've been trying. I think we've been. No, I mean seriously. I mean, this is something that is the need of the hour. To be very honest, because there is a fantastic industry to be grown, right?
Yeah.
Uh, Globally, if you see, uh, hedge funds or alternate funds, are close to about 12 to 15% of a client's portfolio or investor's portfolio or total money pool. In India, we are nowhere. Okay,
Sure.
that's the scope of where the industry can grow up. And also, like if you have alternate ways of investing, what you do effectively from a country perspective is basically one, you try and make markets efficient, right? You provide liquidity, you create jobs to various aspects. So it is extremely important to kind of encourage the industry. And I'm not asking for any favors here. What we are only asking here is basically be at a level playing field with the other investment vehicles.
Sure.
And if you are at a level playing field with other investment vehicles, I think it's a strong case to be pushed for. And yeah, God willing, if we get it, then it will be great. Yeah, I mean, we've been working towards that for a few years now.
I'm sure. I'm sure. I remember those times as well. Thankfully, I don't have to worry about that problem anymore. But yeah, absolutely. It's something that is required in terms of just giving a very differentiated product and innovation from some corner
Yeah.
of the investment space in India. Super. Uh, One of the aspects that also comes out, and I'm pretty sure you have your fair share, is tuition fees, right? Uh, what are those mistakes that you've made over your career, and maybe making them even now? But what is that one probably mistake that you'd want to highlight? Where you said that, look, I don't know what I did, but I learned a ton from it.
Yeah, I mean, you always keep on learning. At the end of it, the people who are managing something like if I am managing a strategy, you are at the end of it a human, right? And you always get biased. You always get you know emotionally carried away by the state of the markets lot many a times, right?
Sure.
As I said, the what we have done effectively to mitigate that for kind of being biased or getting swayed by the markets is to have a very tight risk mechanism around it, right? So that even if you kind of get biased or get emotional about it and you do take position sometimes, you get cut out pretty quickly as well, right? So we've learned that if you get biased or if you get emotional about any decision and you don't look at it objectively, the the amount of money which you can lose can be pretty dramatic. Correct. We, I mean, in my 20 years of investing experience, we would definitely have seen many a times as well.
So give me one. Give me one.
Okay, let me give you one great example.
Sure.
In 2004, and I do remember this, is when I was actually trading for a bank, and I was handling the proprietary trading book. And when between 2002 to 2004, there was huge amount of talk on this whole disinvestments, right?
Sure. It still
And
is.
absolutely. So what happened at that point in time is basically everybody was expecting the current dispensation of the government to continue, and so by which that value unlocking to kind of as was assumed that was going to be the case. However, in the election which we saw, it didn't turn out the way people were expecting, and you saw a complete U-turn in terms of the policies for disinvestments.
Sure.
And if you realize, markets actually went down about 20% in that period of time, and the stocks which were kind of all disinvestment candidates, you had the left dispensation also who were part of the government at that point in time. Was very clear that forget about this. There is nothing going to happen here, right? And you saw that kind of destruction of share price during that period of time. I do remember, as I said, that we carried position into an event, right? Uh, which is which is a big mistake. Which I do realize that after that on any of those events, we either go into cash or highly hedged. We do not take a big call. So that's a big mistake. That's a mistake which has made us learn how to mitigate those event risks as well.
Okay, fair enough. Fair. Uh, sort of moving on to another very interesting thing that is playing out sort of in the markets is the India-China sort of US story, right? What is US going to do to China? Is India going to benefit from, people moving away from China? Does India actually have the capacity or the capability as of now to get those goods, services, whether manufacturing, etc.? Where do you see this story going?
Yo, Jay, I think it's a fantastic opportunity which India has on its hands, without a doubt. Okay, but there has to be lot many measures which needs to be taken by the government, and I'll give you a couple of examples. I mean, it's just that the amount of rules, regulations, compliance which we have to put up an industry, right, is just enormous, right? As a suggestion, there are a couple of suggestions which I would want to give government here at this point, from this platform, is basically that one, if they can have a single window clearance for everything,
Sure.
okay. Two, that target for 20 to 25% reduction in every conditions you have for doing any work. So, for example, again, I have so in our industry, there are AIF rules and regulations. Okay, that you need to comply with 20-25 rules. What I would suggest is make it as easy as possible. Cut 25% of the conditions, right? The cost of compliance would go dramatically down, and the ease of business would increase disproportionately, right?
Sure.
So, as a measure, I would really want them to seriously consider to cut down on these whole regulatory conditions to give a single window clearance. But as you rightly mentioned, the opportunity is huge. If I'm a company in US and I'm looking at how the US China is kind of behaving, and I have my manufacturing plants in China, I would be seriously, as a board member, I would be seriously considering
Sure.
to kind of diversify from China. No doubt about it. Whether it can be Vietnam, it can be Taiwan, it can be Thailand, it can be Bangladesh, it can be anything, or India. My
Sure.
sense is if India is India being a very vibrant democracy has definitely a good advantage. But in terms of getting this over, in terms of red tapeism, rules, regulations, is it needs to be tackled, very very aggressively.
Sure. No, makes sense. And I'm pretty sure what you are echoing is half the people or more than half the people on the street want it. Somehow I think, things keep coming up and it's much slower than people would have expected. But, we are almost at the end of this conversation, Vaibhav. We talk to a lot of investors, fund managers, etc. And we know that uh, these have been tough times for a lot of people, right? Specifically for people who have maybe just started off in their careers in investing in the last year, last 6 months or so. Based on your experience, I'm not asking you to compress all the experience you have into one piece of advice, but what is that one most important piece of advice that you give to young fund managers right now?
So my piece of advice would be for all of them is basically, in fact, two advices. One, never ever ignore the risk aspect of your investments, and two, always be flexible in your investment approach, right?
Sure.
Why am I saying flexible, and which is very counterintuitive? Is basically people would think that please hold a company for 10 years and 15 years and you would make huge amount of money, and mathematically it looks fantastic. But let me give you one example. Between 2000 to 2020, if you would have only invested in Nifty, right? you would have made 11.5% CAGR return, which is not bad. Okay,
Sure.
not extraordinary, but not bad as well.
Sure.
How many people would have done that, right? There are many investment gurus who would say, please hold for the long time. But we have to understand our own selves. What is it that we are capable of? And two, if we have a pretty tight risk and return matrix to kind of address, you have to be very flexible in your investment approach. You have to adapt to the environment and keep on getting the opportunities on your investment side. So, two things: risk management and flexibility in approach is what I would probably give them as an advice.
Okay, fantastic. Vaibhav, let me first thank you for your time. I can see a whiteboard. I'm assuming you are in office and trying to make money for your clients. So thank you so much for your time that you took out. And here's wishing you and your team the next decade of outperformance, alpha, and great returns. Again,
Thank you
thank you
very
so
much.
much for your time, Vaibhav.
Thank you very much, Jay. It's been a pleasure talking to you as always, and thank you for having me on the Juggernaut. Thanks.
Super. We'll catch up soon, Vaibhav.
Sure, definitely.
Okay.
Thanks.
See you.
Cheers.
Bye.
Bye. Bye.